The richest 1% of people control about $150 trillion in wealth globally, but the world's total debt has reached $324 trillion. Global debt now exceeds global GDP by over 300%. That means even if you took every dollar from every billionaire and millionaire on Earth, you still couldn't pay off half of what the world owes. So where does the other $174 trillion come from? The answer reveals a system where debt isn't just borrowed money. It's digital money creation through modern banking, where typing numbers into computers generates trillions in obligations. This paradox exposes how our entire economy runs on something far stranger than most people realize. The numbers that don't add up. Let's look at the actual numbers behind this strange system. America's debt sits at $36.22 trillion right now, and it's projected to surpass $37 trillion by December 2025. To put that in perspective, if you stacked dollar bills that high, the pile would reach from Earth to the moon and back again 50 times. But America isn't alone in this predicament. China carries $21 trillion in debt. Japan holds $11 trillion. Germany owes $3 trillion. France $3.2 trillion. When you add up every nation on Earth, the total comes to $324 trillion. That's not a typo, $324 trillion. Here's where things get strange. The entire world economy only produces about $100 trillion worth of goods and services each year. So the global debt is more than 3 times larger than everything humanity actually makes, grows, or builds combined. If every person on Earth worked for free and gave away everything they produced for 3 straight years, we still wouldn't have enough to pay off what we owe. Since the pandemic started in 2020, global debt has grown by $82 trillion. That's more than the entire economic output of the United States, China, and Europe combined. In just 5 years, the world added more debt than it had accumulated in the previous 50 years. The numbers have accelerated so fast that economists are running out of ways to measure them meaningfully. But here's the real puzzle. If you took every asset on Earth and sold it at current market prices, you'd get maybe $280 trillion. That includes every building, every piece of land, every company, every gold bar, every stock certificate, and every dollar in every bank account. Liquidate absolutely everything that exists, and you're still $44 trillion short of paying off global debt. The math simply doesn't work. This creates an obvious question. If there isn't enough money or wealth in existence to pay off what we owe, then what exactly is debt? Traditional economics says debt represents money that was borrowed from someone who had it and lent it to someone who needed it. But the numbers prove this can't be true. There isn't enough actual money in the world to account for the debt that exists. Think about it this way. If I lend you $100, I have $100 less and you have $100 more. The total amount of money stays the same. But somehow global debt has grown 3 times faster than global wealth for decades. Money keeps appearing from nowhere, getting lent out, and creating obligations that mathematically shouldn't exist. The strangest part is that this system hasn't collapsed. Every day, countries continue borrowing billions more. Banks keep lending, interest gets paid, the whole machine keeps running despite operating on what appears to be phantom money. Central banks create new currency by typing numbers into computers. Governments issue bonds that people buy with money that didn't exist until the moment they bought them. The debt grows, but somehow so does the economy. This isn't just an accounting error or a temporary imbalance. It's how modern economics actually works. Debt has become a technology for creating wealth rather than just transferring it. When a bank approves a mortgage, they don't take money from their vault and give it to you. They create new money digitally, add it to your account, and simultaneously create a debt obligation. The money supply expands instantly. The debt exists before the money does. Most people assume that when their government borrows money, it comes from wealthy investors, foreign nations, or shadowy financial institutions. But the data tells a different story. The biggest holders of government debt aren't billionaires or foreign powers. They're ordinary institutions that regular people interact with every day. Insurance companies hold trillions in government bonds using premiums from car insurance and life insurance policies. Pension funds own massive portions of national debt, funded by retirement contributions from teachers, firefighters, and office workers. Your own bank account likely contains government debt. When banks hold deposits, they're required to invest a portion in government securities for regulatory reasons. So your savings account is simultaneously lending money to the government and being guaranteed by that same government. The circular nature of these relationships means that traditional ideas about who owes what to whom break down completely. Even more bizarre, many countries are simultaneously major debtors and major creditors. Japan owes $11 trillion, but also holds $4 trillion in foreign government bonds. Germany has $3 trillion in debt while lending $2 trillion to other nations through various financial instruments. These countries are essentially lending money to themselves through complex international networks of banks, funds, and government agencies. The growth rate of this phantom money has accelerated dramatically since 2020. During the pandemic, central banks created more new money in 2 years than they had in the previous 2 decades combined. Government spending programs appeared overnight. Corporate bailouts materialized instantly. Emergency lending facilities provided unlimited liquidity to financial markets. None of this money existed before it was needed, but all of it created new debt obligations. What's particularly unsettling is how normalized this process has become. When the Federal Reserve announces it will purchase $2 trillion in government bonds, financial markets barely react anymore. The creation of massive amounts of debt-based money has become routine. Politicians promise new spending programs worth hundreds of billions without explaining where the money will come from, because everyone understands it will simply be created through borrowing. This system works as long as people have faith that future economic growth will be large enough to support current debt levels. Every loan, every bond, every government obligation represents a bet that tomorrow's economy will be bigger and more productive than today's. The debt isn't really owed to specific people or institutions. It's owed to the idea that human society will continue expanding indefinitely. But mathematical limits exist even for money creation. Interest payments on government debt now consume larger portions of national budgets each year. The US government alone will spend $870 billion on interest payments in 2025. When debt grows faster than the economy that supports it, the burden becomes unsustainable. Several countries are already approaching debt-to-GDP ratios that historically preceded financial crises. The reason the math doesn't add up is because most global debt represents future money that hasn't been created yet. It's a claim on economic activity that may or may not happen. The system depends entirely on the assumption that economies will grow fast enough to validate the debt they've created. If that assumption proves wrong, the phantom money disappears and the debt remains. But the real mystery isn't just the size of these numbers, it's how the money actually moves through the system. The circular money machine. The debt doesn't actually flow from lenders to borrowers in straight lines like most people imagine. Instead, it moves in circles. Money goes out as loans and comes right back as deposits, creating loops that feed themselves endlessly. Take the California Teachers' Retirement System. This pension fund manages $350 billion in assets for retired educators across the state. Where does that money get invested? A huge portion goes into U.S. Treasury bonds. So when a retired teacher receives her monthly pension check, that money originally came from the U.S. government paying interest on bonds that her own pension fund bought with contributions from active teachers. The government borrows money from teachers to pay retired teachers, while current teachers fund the system that will eventually pay them. Everyone is simultaneously lending to and borrowing from the same pool of money. This pattern repeats across the entire financial system. U.S. pension funds collectively held $4 trillion in Treasury bonds as of 2024. These aren't foreign investors or shadowy financial institutions. They're retirement systems for firefighters, police officers, nurses, and government employees. The money comes from payroll deductions that get pooled together and lent back to the same government that employs these workers. A postal worker in Denver contributes to a federal pension system that buys Treasury bonds, which fund the postal service that pays his salary. The circle completes itself. Your bank account works the same way. When you deposit $10,000 into a savings account, the bank doesn't lock that cash in a vault with your name on it. Instead, they're required by federal regulations to invest a portion of customer deposits in government securities. U.S. banks held $1.8 trillion worth of Treasury bonds purchased with customer deposits. So your savings account money gets lent to the U.S. government, which uses it to fund programs like Social Security, Medicare, and federal employee salaries. Then the government pays interest on those bonds back to your bank, which credits a portion to your savings account as interest earnings. Your own money travels in a complete circle from your pocket to the government and back to your pocket, picking up interest along the way. This circular system has grown explosively since 2020. During the pandemic, the Federal Reserve created $4 trillion in new money to purchase government bonds. But where did they buy those bonds from? Primarily from banks, pension funds, and insurance companies that had originally purchased them with deposits, premiums, and contributions from ordinary Americans. The Fed essentially bought government debt from institutions using newly created money, which those institutions then used to buy more government debt. The circle expanded, but the fundamental loop remained intact. Consider how this affects a middle school teacher in Ohio. She contributes 8% of her salary to the state pension system every month. That pension system invests heavily in Treasury bonds. The interest payments from those bonds help fund her future retirement benefits. But those same Treasury bonds are backed by federal tax revenue, which includes the income taxes she pays on her teaching salary. So she's effectively lending her own tax money back to herself through the pension system, paying herself interest, and funding her own retirement with the returns. The government acts as a middleman in a transaction where she's both the lender and the ultimate beneficiary. The self-reinforcing nature of these loops becomes apparent when you follow the interest payments. When the US government pays $800 billion annually in interest on the national debt, that money flows directly back to American banks, pension funds, and insurance companies. Those institutions then have $800 billion more to lend, much of which gets invested in more government bonds. The interest payments create new lending capacity, which generates more debt, which produces more interest payments. Each cycle expands the total amount of money moving through the system. But here's what makes this particularly unstable. The loops only work as long as new money keeps entering the system faster than old money leaves. Pension funds need constant contributions from active workers to pay retired workers. Banks need steady deposits to maintain their government bond purchases. If any part of this flow stops or reverses, the circular system starts breaking down. Demographics are already straining these circles. As baby boomers retire, pension funds face more money going out in benefits than coming in through contributions. The California teachers' retirement system, despite holding $350 billion in assets, faces a $107 billion unfunded liability because benefit payments will soon exceed contribution income plus investment returns. When pension funds need to sell government bonds to pay retirees, they're removing money from the circular flow rather than adding to it. The mathematical reality is stark. If pension contributions decline and bank deposits shrink, the circular flow of money that supports government borrowing starts reversing. Instead of money flowing into the system and expanding in loops, money begins flowing out and the loops contract. When loops contract, the government must find new sources of funding or reduce spending dramatically. Most countries are essentially lending money to themselves through these complex financial loops. The appearance of external creditors exists, but when you trace the money flows completely, domestic institutions funded by domestic savers hold the majority of government debt in almost every developed nation. The circles are so intertwined that the distinction between creditor and debtor becomes meaningless. The speed at which these loops can break is what makes the system particularly fragile. Digital money moves instantly. A pension fund can sell $10 billion in government bonds with a few computer commands. When multiple institutions simultaneously need to convert bonds back to cash, the circular flow can reverse in days rather than months or years. But the strangest part of this entire circular system is what happens when governments need more money than these domestic loops can provide. That's when the real magic begins. The ghost money phenomenon. Central banks create reserves electronically to buy government bonds. When the Federal Reserve decided to inject $4 trillion into the economy during the pandemic, a central bank employee sat at a computer, opened a digital interface, and typed in the numbers. $4 trillion appeared on balance sheets instantly. No printing presses ran, no gold moved from storage, no existing money changed hands. The debt existed the moment someone pressed enter on a keyboard. The Bank of England, European Central Bank, and Federal Reserve all operate this way. When the US Treasury needs to fund a new spending program, they issue bonds. The Federal Reserve purchases those bonds by creating new money electronically and crediting the Treasury's account. The entire transaction happens through computer entries. The government suddenly has billions to spend, and the central bank holds billions in new debt obligations. The process sounds almost too simple to be real, but it's documented in central bank publications worldwide. The Bank of England openly states that commercial banks create money when they make loans, and central banks create money when they buy government securities. The European Central Bank describes quantitative easing as creating money electronically to buy bonds. The Federal Reserve's own website explains that they increase the money supply by purchasing Treasury securities with newly created reserves. During March 2020, the Federal Reserve created more money in a single month than existed in the entire U.S. economy in 1980. Their balance sheet expanded by $2.3 trillion in 8 weeks. Every dollar of that expansion represented new debt obligations that appeared purely through digital accounting. The money didn't come from anywhere. It simply started existing when central bank computers recorded the transactions. This ghost money becomes real the moment it enters circulation. When the government spends newly created funds on infrastructure projects, those dollars pay construction workers who deposit them in banks. The digital entries transform into tangible economic activity. Workers buy groceries with money that didn't exist weeks earlier. Grocery stores pay suppliers with funds that originated as computer keystrokes. The phantom currency integrates seamlessly into the physical economy. But the underlying reality remains unchanged. Most of the money supply consists of digital records rather than physical currency. Only about 8% of US dollars exist as paper bills and coins. The remaining 92% lives as electronic entries in computer systems. When banks process electronic transfers, they're moving digital information rather than tangible assets. Your paycheck deposit, mortgage payment, and credit card transactions all involve shuffling numbers between electronic accounts. The pandemic revealed how quickly this system can expand. In 2021, global central banks added $17 trillion in new money within 12 months. That amount exceeded the entire economic output of the United States. Governments launched spending programs worth trillions without raising taxes or cutting other expenses. The money materialized through central bank purchases of government bonds using freshly created digital currency. Emergency lending programs appeared overnight with unlimited funding capacity. The Federal Reserve established facilities that could theoretically create infinite amounts of money to support financial markets. The European Central Bank launched similar programs with no predetermined limits. These facilities didn't tap existing reserves or redirect funds from other sources. They operated by creating whatever amounts the situation required through digital money creation. The speed of expansion has accelerated dramatically since 2020. Central banks now create money faster than economies can absorb it productively. The Federal Reserve's balance sheet grew from $4 trillion to $9 trillion in 2 years. The European Central Bank expanded from 4.7 trillion euros to 8.8 trillion euros. The Bank of Japan reached 740 trillion, equivalent to 130% of Japan's entire economic output. These expansions happened purely through digital money creation rather than economic growth. What makes this particularly unsettling is how normalized the process has become. Financial markets expect central banks to create whatever money governments need. Politicians propose spending programs worth hundreds of billions without explaining funding sources because everyone understands the money will be created digitally. Economists debate the optimal pace of money creation rather than questioning whether creating money from nothing creates sustainable prosperity. The beneficiaries of this system are institutions positioned to receive newly created money first. When central banks buy government bonds, they purchase them from primary dealers who profit from the transactions. When governments spend newly created funds, the recipients benefit from fresh purchasing power before prices adjust to accommodate the expanded money supply. Financial institutions that facilitate these transactions collect fees on trillions in newly created money. But the system depends entirely on public faith in digital money creation. If people lose confidence that electronically created dollars represent real value, the entire structure collapses instantly. Unlike physical gold or silver, digital money has no intrinsic worth beyond social agreement that computer entries represent purchasing power. The numbers in bank accounts only matter because everyone agrees they matter. Historical currency collapses show what happens when this faith disappears. But modern examples like the Bank of Japan's balance sheet, exceeding 130% of GDP, demonstrate how far digital money creation can extend before hitting limits. The mathematics of ghost money creation reveal fundamental problems. When central banks create money faster than economic output grows, each unit of currency represents a smaller slice of actual goods and services. The new money doesn't create new products or increase productivity. It simply divides existing economic output among more currency units. Interest payments on digitally created debt compound the problem. When governments pay interest on bonds purchased with newly created money, they're paying real resources to service obligations created from nothing. The interest comes from tax revenue representing actual economic activity, while the original debt came from computer entries. Real productivity services phantom obligations. Current debt levels require continuous money creation to remain sustainable. If central banks stopped creating new money, governments couldn't refinance existing obligations when they mature. The system has reached a point where stopping money creation would trigger immediate debt crises, but continuing money creation undermines the currency's credibility. Digital money creation has become the primary mechanism supporting government spending worldwide. Most government debt now represents claims on money that didn't exist when the obligations were created. The debt appears real because it generates real interest payments and real economic consequences, but the underlying money supply consists primarily of digital entries rather than tangible wealth. The majority of global debt exists only as electronic records in computer systems operated by central banks and commercial financial institutions. But the institutions buying this digitally created debt aren't just the usual suspects anymore. The new creditor nations. Germany's net external creditor position reached $3.73 trillion in 2024, making it the world's largest creditor nation for the first time since 1991. This shift reflects aging populations in developed nations, creating massive pools of savings that need investment outlets. Unlike Japan's direct investments in emerging market debt, Germany's creditor status comes primarily through portfolio investments in government bonds and corporate securities across multiple countries. The transformation happened remarkably fast. 5 years ago, most financial analysts expected China to dominate global lending as their economy continued expanding. Instead, China's national debt is projected to reach $26.5 trillion by 2029, forcing them to focus on domestic obligations rather than international lending. Chinese banks that once eagerly purchased American and European bonds are now primarily occupied with funding their own government's infrastructure projects and manufacturing investments. The speed of this transformation becomes clear when you examine specific creditor relationships. Saudi Arabia's sovereign wealth fund now holds over $400 billion in foreign government bonds, making them a larger creditor than most European nations. The United Arab Emirates has accumulated similar holdings through their various investment authorities. These oil-rich nations converted decades of energy revenue into massive portfolios of government debt from countries that once dominated the global financial system. But the most dramatic shift involves former colonies lending to their former colonial powers. Nigeria's pension funds hold billions in British government bonds. India's central bank maintains substantial positions in European debt markets. Brazil's development bank has become a significant lender to American corporations and municipalities. The historical irony is striking. Countries that once struggled to secure basic development loans from Western institutions are now financing the retirement systems and infrastructure projects of their former rulers. This reversal creates entirely new forms of economic leverage. When Britain needs to refinance its debt, they increasingly depend on investment decisions made in Riyadh, Abu Dhabi, and Mumbai. American state governments selling municipal bonds find their largest buyers are sovereign wealth funds controlled by nations with fundamentally different political systems and strategic interests. The geopolitical implications multiply when you consider the concentration of these new creditor relationships. A handful of commodity-exporting nations control disproportionate shares of global lending capacity. Saudi Arabia, UAE, Qatar, and Kuwait collectively hold over $2 trillion in foreign government debt. Their lending decisions can determine whether entire countries can refinance their obligations or face default. Energy revenues drive much of this shift. Oil prices above $80 per barrel generate surplus cash that oil-producing nations must invest somewhere. Traditional options like real estate and corporate stocks can't absorb the massive flows generated by energy exports. Government bonds remain the only market large enough to handle hundreds of billions in investment flows from individual countries. The mathematics work differently when your creditors control essential resources. European nations borrowing from Middle Eastern sovereign wealth funds can't simply default on their obligations without risking energy supply disruptions. American states issuing bonds to Gulf nation investors face similar constraints. The debt relationships create strategic dependencies that extend far beyond financial markets. Developing nations are simultaneously becoming creditors and facing debt crises from previous borrowing. Countries like Malaysia and Indonesia lend money to developed nations through their sovereign wealth funds while struggling to service debt from earlier development projects. This creates complex circular relationships where emerging economies lend to developed countries that provide aid and development assistance back to emerging economies. The timeline for these shifts has compressed dramatically. Relationships that historically took decades to develop now change within months. When commodity prices spike, exporting nations instantly gain massive lending capacity. When energy markets crash, previous creditors can disappear from bond auctions overnight. The Federal Reserve tracks foreign government bond holdings monthly because the composition changes so rapidly. China presents the most complex case in this new creditor landscape. Despite their own rising debt levels, Chinese institutions still hold $1.8 trillion in foreign government securities, but their role has shifted from net lender to selective creditor. Chinese banks now focus their international lending on countries participating in Belt and Road Initiative projects, creating strategic rather than purely financial relationships. The concentration of creditor power in fewer hands creates systemic risks that didn't exist when lending was distributed among many Western financial institutions. If Saudi Arabia's investment committee decides to reduce their holdings of European bonds, entire markets can shift overnight. When Norwegian pension funds adjust their asset allocation strategies, American municipalities notice immediate impacts on borrowing costs. Traditional credit rating agencies struggle to assess these new relationships. Standard & Poor's and Moody's built their models around Western financial institutions with predictable investment patterns. Sovereign wealth funds from authoritarian governments operate with different time horizons and risk tolerances that don't fit conventional analysis frameworks. The political implications extend beyond economics. When Qatar's sovereign wealth fund owns significant portions of French government debt, French politicians must consider Qatari interests when making foreign policy decisions. When UAE investments support American infrastructure projects, American officials face pressure to accommodate UAE strategic objectives. Banking systems in creditor nations have transformed to handle these massive investment flows. Emirates NBD and Qatar National Bank now operate sophisticated government bond trading desks that rival traditional Wall Street institutions. Their decisions about which countries deserve investment affect global interest rates and government funding costs. The reversal has happened so quickly that many political leaders haven't adjusted their thinking. American and European officials still approach international negotiations as if they hold all the financial leverage. But the reality is that their countries increasingly depend on investment decisions made in capital cities they previously ignored. Currency dynamics amplify these power shifts. When oil revenues flow to Middle Eastern creditors, those nations can choose which currencies to hold their debt investments in. Their preferences affect exchange rates and the relative costs of government borrowing in different markets. The traditional debtor-creditor map has been completely redrawn, with former colonies now lending to former empires. But governments aren't the only institutions that have become major players in this debt ecosystem. Private corporations have quietly accumulated massive positions in government securities, transforming themselves into unofficial participants in the global lending system. The corporate debt web. Apple holds $24 billion in treasury securities. Microsoft owns $76 billion worth of government bonds. Amazon maintains $53 billion in various government debt instruments. These aren't financial companies or banks making strategic investments.